Hello there. So this is for the subject capital markets, and the topic for this specific video is risk and return, or risk return trade-off. We have here an article from investopedia.com. Okay. So for the definition, what is risk return trade-off? So it states that the potential return rises with an increase in risk. Okay. So but then again, from our previous discussions, the increased risk does not actually guarantee the increased returns. Okay, there's just the possibility of having higher returns the more risk that you are willing to take on. Using this principle, individuals associate low levels of uncertainty with low potential returns, and high levels of uncertainty or risk with high potential returns. According to the risk-return trade-off, invested money can render higher profits only if the investor will accept a higher possibility of losses. Okay, so again, with a higher possibility of profits, there's also the higher possibility of losses. So if you have an investment of 100,000 and you're expecting a return of maximum 20,000 for a total of 120,000 investment plus return, there is a risk that, that's how much you can earn, but there's also the possibility that that's also the same amount that you can lose. Okay, so instead of 100,000 becoming 120,000, it could become, say, 80,000. You are essentially losing 20,000 pesos. So there's also that possibility. The higher level of risk that you're willing to take, it also means that that's also how much you're willing to, in a way, it's some sort of gambling. That's also the amount of money that you're willing to lose. All right. Understanding risk-return trade-off, the trading principle that links high risk with high reward. Okay. The appropriate risk-return trade-off depends on a variety of factors, including an investor's risk tolerance, depending on, your risk appetite. Are you a conservative, moderate, or aggressive investor? The investor's years to retirement. Normally, if you're older and, you just have a few years until retirement, you are more conservative. Whereas if you are younger and you have more years ahead of you to do investments and to save money, then you are more aggressive when it comes to your investment. And the potential to replace lost funds. So if you have a higher income and the amount of money that you're going to put in investment is money that, you would not be needing in the short term or in the long term, and that you also, you also wouldn't be negatively impacted if you lose the whole amount of the investment, then you're more likely to be an aggressive investor, okay, compared to those who, don't have that much money, and the money that they're going to put into an investment is something that they really couldn't, stomach to lose. So conservative. Time also plays an essential role in determining a portfolio with appropriate levels of risk and reward. Short-term are normally low levels of risk, and then long-term investments are normally high-risk investments. Okay. For example, if an investor has the ability to invest in equities over the long term, that provides the investor with the potential to recover from the risk of bear markets, low price markets, and participate in bull markets, high prices. While if an investor can only invest in a short time frame, the same equities have a higher risk proposition. I think it will also depend on, time frame and what they call this, type of investment. In bonds, normally the shorter the better, so shorter, lower risk. But when it comes to stocks, it will depend, right, on the goals and objectives of the investor. Okay, sometimes it could work on short term, sometimes it could work on long term, right? Investors use the risk-return trade-off as one of the essential components of each investment decision, as well as to assess their portfolio as a whole. At the portfolio level, the risk-return trade-off can include assessments of the concentration or diversity of holdings and whether the mix presents too much risk or a lower than desired potential for returns. Okay, so you have your diversified portfolio, right? And what you want to do is to get an average that is acceptable. Okay, it's possible that you have investments that are in low returns or low returns, low risk investments, and then also possible that you have investments in high risk, high return types of investment, and everything in between. Okay, and that's how you diversify your holdings. Key takeaways. The risk-return trade-off is an investment principle that indicates that the higher the risk, the higher the potential for reward, but again, it's the same potential for losses. To calculate an appropriate risk-return trade-off, investors must consider many factors, including overall risk tolerance, potential to replace lost funds, and others. Investors consider the risk-return trade-off on individual investments and across portfolios when making investment decisions. Right? Special considerations: measuring singular risk in context. When an investor considers higher risk, high return investments, the investor can apply the risk-return trade-off to the vehicle on a singular basis as well as within the context of the portfolio as a whole. So probably in benchmarking, can set a level of risk that you can tolerate, and you compare, every investment in your portfolio whether they are within that particular limit. Okay, so it can apply it to individual investments or to the average of the whole portfolio. Examples of high risk, high return investments include options, penny stocks, and leveraged exchange traded funds. Generally speaking, a diversified portfolio reduces the risk presented by individual investment positions. Okay, having a portfolio really reduces the risk compared to individual investments. For example, a penny stock position may have a high risk on a singular basis, but if it is the only position of its kind in a larger portfolio, the risk incurred by holding the stock is minimal. Okay, because other investments in the portfolio could counteract or balance off the effects of that particular investment. Risk-return trade-off at the portfolio level. That said, the risk-return trade-off also exists at the portfolio level. For example, a portfolio composed of all equities presents both higher risk and higher potential returns. Okay, I don't know why you would have a portfolio that are all stocks, right? When you create a portfolio, you have to make sure you have different types of investments. So you have bonds, you have government bonds, and then you have your equities, and then derivatives if possible. Okay, you can't just put everything in equities regardless of equity of different companies across various industries. That's still risky. Okay, within an all-equity portfolio, risk and reward can be increased by concentrating investments in specific sectors or by taking on single positions that represent a large percentage of holdings. Okay, you can still, there's still a way to diversify that, different sectors, but still, compared to a portfolio with different types of securities, though, this is still riskier. For investors, assessing the cumulative risk-return trade-off of all positions can provide insight on whether a portfolio assumes enough risk to achieve long-term return objectives, or if the risk levels are too high with the existing mix of holdings. Okay, have to make sure that the average or total returns of across all investments in the portfolio is at a level high enough for you to earn a profit, because if it's, very low, then the real return might not be much. So you have to, get as much as you can. You set it the highest rate that you can tolerate. Okay, and then of course, with regards to balancing it out with other types of investments across different companies and across different industries. Okay, high enough for the returns could be as high enough as you can tolerate the risk as well. Alright, so that's it for this one. Thanks and bye.